What if I told you that the debt on your credit card is a trap, but the debt on a billionaire's balance sheet is a ladder? Most of us are taught to fear debt. Pay it off. Avoid it. Stay clean, and on the surface that sounds like responsible advice. But here's what nobody tells you. While you were trying to zero out that credit card balance, Jeff Bezos was borrowing billions. Elon Musk was pledging Tesla shares as collateral to fund his next move. Real estate investors were buying entire apartment buildings with the bank's money and charging you rent. The wealthy aren't avoiding debt. They're engineering it. And in the next 15 minutes, I'm going to show you exactly how the system works, the mechanics, the mindset, the strategies, and why the fear of debt might be the single most expensive belief you were ever handed. This is not financial advice. This is financial education. The kind they deliberately skip in school. Chapter 1. 2 kinds of debt. Let's start with something that sounds simple but changes everything once you really understand it. Not all debt is the same. There are 2 completely different kinds of debt in this world, and almost nobody explains the difference clearly enough for it to actually stick. The first kind is what most people know: credit cards, car loans, buy now, pay later. Personal loans to cover a holiday, a new phone, a lifestyle that costs more than it should. This debt takes from you. Every single month, interest compounds quietly in the background. The bank profits. You fall further behind. And it's designed around things that lose value the moment you buy them. A $35,000 car is worth $27,000 the second you drive it off the lot. A new phone, a vacation, a wardrobe. These things are gone the moment you spend the money. And the debt stays. But the second kind of debt, that's a different animal entirely. This is the debt that pays you. Debt used to purchase assets. Things that generate income, or grow in value over time, or both. Think about this. A real estate investor borrows $800,000 from a bank to buy an apartment building. The tenants pay rent every month. That rent covers the mortgage, and then some. 20 years later, the building is worth $2 million. Who did most of the heavy lifting? The bank's money. Now here's the question most people never stop to ask, and it's an important one. Why did you learn about the first kind of debt growing up, but never the second? Because the answer tells you a lot about who the financial system was actually designed to serve. Chapter 2. How the Wealthy Actually Borrow in 2021. A major investigative report from ProPublica revealed something that genuinely stunned a lot of people. Some of the wealthiest Americans, people like Warren Buffett and Jeff Bezos, paid little to no federal income tax in certain years. Not because they cheated. Not because of loopholes in the dramatic sense people imagine. But because they understand a strategy that almost nobody talks about openly. It's called buy, borrow, die. Here's how it works. Step 1. You buy assets, stocks, real estate, businesses, things that appreciate over time. Step 2. Instead of selling those assets, which would trigger a taxable capital gains event, you borrow against them. At very low interest rates, often as low as 2 or 3%, you live off that loan, and a loan is not income, so it's not taxed. Step 3. You die. Your heirs inherit those assets at what's called a stepped-up cost basis. The outstanding loan gets repaid, and the capital gains that would have been taxed, they're largely wiped out. Now, you might be thinking, I don't have billions in Amazon stock to borrow against, and that's fair. But the principle scales down. And truly understanding the principle is where everything starts to change. Because here's where the math gets uncomfortable. If wealthy investors are borrowing at 3 to 4% interest and their assets are growing at 8 to 12% per year, they are effectively making money by being in debt. Their debt is generating wealth. Your debt is destroying it. That gap right there is where financial inequality compounds year after year after year. And if this kind of deep breakdown is what you're looking for, subscribe to Elite Wealth Hub, because this is exactly the type of money story that doesn't make it into mainstream financial media. We break it all the way down. Chapter 3. The Lever That Moves the World. Archimedes once said, "Give me a lever long enough and a fulcrum on which to place it, and I shall move the world." Most people hear that as a physics lesson. Wealthy people hear it as a business model. That lever has a name in finance. It's called leverage, and the fulcrum is other people's money. In 1901, J.P. Morgan acquired U.S. Steel for $480 million, the first billion-dollar corporation in American history. He didn't write a personal check. He structured the deal with other people's capital, controlling a massive asset with a fraction of what it was truly worth. That single deal reshaped American industry for the next century. In the 1970s and 80s, Sam Walton expanded Walmart across America not by being the richest man in the room, but by using bank financing and supplier credit to open stores faster than any competitor could react. By the time rivals understood the strategy, it was too late. And in the modern era, private equity firms like Blackstone routinely acquire companies using what's called a leveraged buyout. They put in a fraction of the purchase price themselves, finance the rest with debt, and then use the acquired company's own cash flow to pay that debt down. By the time the loan is repaid, they own the entire asset, largely on someone else's dime. The pattern is always the same. Vision plus leverage equals disproportionate outcomes. Now, leverage cuts both ways. I want to be honest about that. And we're going to talk about the dark side of this in just a few minutes. But first, I need you to sit with something that genuinely changed the way I think about money. The average person works for money. The wealthy put money to work. And leverage is the mechanism that lets a relatively small amount of capital control a much larger amount of value. It's not magic. It's not luck. It's not something reserved for the elite. It's mechanics. And once you understand the mechanics, the game looks completely different. Chapter 4. The Interest Rate Game, and How to Win IT. Here's where most people make their single most expensive mistake. They treat all interest rates the same. A 22% credit card APR and a 5% mortgage feel like variations of the same thing. Debt is debt, right? Wrong. And the difference between those two numbers is the difference between financial ruin and financial freedom. Let's do some real math. If you borrow $10,000 on a credit card at 22% interest and carry that balance for 10 years without paying it off, you will have repaid over $37,000 in total. You borrowed $10,000. You paid back nearly 4 times that. Now flip it. A real estate investor borrows $300,000 at 6.5% interest to purchase a rental property. The rent comes in at $2,400 a month. The mortgage payment is $1,900. That's $500 a month in positive cash flow, $6,000 a year, on money that wasn't even theirs to begin with. And the property itself is appreciating. Same concept, borrowing, completely different result. The wealthy obsess over something called interest rate arbitrage. It's the gap between what you pay to borrow and what your assets return. Borrow at 5%. Earn 10%. You're generating 5% annually on somebody else's capital. That's the game. And now you understand why the wealthy push so hard for low interest rate environments. Because cheap borrowing means cheaper leverage. Cheaper leverage means faster wealth accumulation for those who know how to use it. Think about that for a moment. Who does a rising interest rate environment actually hurt most? The billionaire with a fixed-rate 30-year real estate portfolio? Or the working family carrying $8,000 in high-interest credit card debt that just got more expensive? The answer is uncomfortable, but it's important. Chapter 5. 3 strategies real people actually use. Alright. Enough theory. Let's talk about what this looks like in practice, for real people, not just hedge fund managers. Because the gap between what the ultra-wealthy do and what an ordinary person with financial discipline can do is genuinely smaller than most people believe. The most accessible form of strategic debt historically has been real estate. A standard mortgage with a 20% down payment gives you 100% control of an asset. That's 5-to-1 leverage, built directly into the system that most people already have access to. If a $400,000 property rises 10% in value, you've made $40,000 on your $80,000 down payment. That's a 50% return on your actual invested capital, while the bank funded 80% of the purchase. This is why real estate has created more millionaires than almost any other wealth vehicle in the last 100 years. It's not glamorous. It doesn't go viral. But the math is hard to argue with. The second strategy is what entrepreneurs call OPM, other people's money. When you raise capital from investors, take on a business loan, or structure a deal where someone else provides the funding in exchange for a return. You're doing exactly what JP Morgan did in 1901, using leverage to build something larger than your own capital would allow. Amazon went public in 1997 with massive losses on its books. Jeff Bezos wasn't panicking. He was using public capital to build infrastructure that nobody else could afford to match. Today, Amazon's annual revenue exceeds $550 billion. Leverage wasn't a risk to Bezos, it was the entire strategy. The third strategy is something called a securities-backed line of credit. If you have an investment portfolio, you can borrow against it, typically at 50 to 70% of its value, at interest rates far below what a credit card or personal loan would charge. No forced sale. No capital gains tax triggered. Just access to capital when opportunity appears. This is what Elon Musk used in 2022, pledging Tesla shares as collateral to fund acquisitions without liquidating his position. Now, this comes with real risk. A sharp market decline can trigger a margin call, forcing liquidation at the worst possible moment. Which brings me to the part of this nobody wants to hear. But it's the most important part. If you're finding this valuable, go ahead and hit the like button. It genuinely helps us reach more people who need this information. Chapter 6. The Dark Side, and the Rule that Separates the Rich from the Ruined. You know the name. You know the broad story. But let me give you the version that actually matters. The 2008 financial crisis was not caused by debt itself. It was caused by reckless leverage on worthless assets. Banks like Lehman Brothers were leveraged 30 to 1. For every single dollar of equity on their books, they owed $30 in debt. When the housing market declined by just a few percentage points, not even a collapse, just a correction, the entire structure fell apart in a matter of weeks. In the months that followed, Americans lost over $10 trillion in stock market wealth. 8 million jobs disappeared. Millions of families lost their homes. Communities that took a generation to build were hollowed out almost overnight. Leverage didn't fail those people. Leverage on garbage assets failed those people. Now compare that to Warren Buffett in the same crisis. Buffett was also leveraged through Berkshire Hathaway's insurance operations, which gave him access to what he calls float, cheap, long-duration capital. But his underlying assets were fundamentally sound businesses with real earnings and durable competitive advantages. When the market crashed in 2008, Buffett didn't panic. He invested $5 billion in Goldman Sachs at the height of the panic, on his terms. Preferred shares, paying a 10% dividend, plus warrants to purchase additional stock at a discount. By 2011, that deal had returned over $3 billion in profit. Same crisis, same leverage concept, completely different outcome. Because the asset underneath was real. The rule that separates wealth builders from the financially ruined is this: leverage quality assets. Never leverage garbage. Before you use any debt strategically, ask yourself 3 questions. Does this debt buy me an asset or a liability? Can I still service this debt if things go wrong? And is the expected return meaningfully higher than the cost of borrowing? If all 3 answers are yes, you're thinking like an investor. If any single answer is no, stop, reconsider, because the same force that builds wealth when pointed in the right direction can destroy it completely when pointed at the wrong thing. Conclusion: flip the script. We started this video with a question. What if the debt on your credit card is a trap, but the debt on a billionaire's balance sheet is a ladder? Now you have the answer. And it's not theory. The wealthy don't avoid debt. They engineer it. They borrow cheap. They buy assets that produce income. They let the math compound quietly in the background while everyone else is focused on paying off the wrong things. Consumer debt, the kind that funds lifestyle instead of assets, is genuinely destructive. Protect yourself from it fiercely. But strategic debt, leverage applied with discipline, patience, and a clear-eyed understanding of the risk, is one of the most powerful tools ever built for closing the gap between where you are and where you want to be. The billionaires know it. The banks know it. The investors know it. Now you know it too. The system wasn't designed to explain this to you. But once you see how the lever actually works, you can't unsee it. And that changes everything. If this shifted the way you think about money, send this video to one person in your life who needs to hear it. Not a list. Not a group chat. Just one smart person you care about. Because this is the kind of conversation that can genuinely change the direction someone's life takes. And that's exactly why Elite Wealth Hub exists. See you in the next one.